Good afternoon, everyone.
Good afternoon, sir.
And
Good afternoon, sir.
Um,
Hi, good afternoon.
So let's start, everyone, now. So we are starting with the FAR, Financial Accounting and Reporting paper. So I think we have already discussed about the pattern. We have already discussed about the weightage of each and every unit. So now I'm just starting with the first unit, which is financial statements. But before we start, just I just want to discuss about the one thing. So in the financial accounting and reporting, mainly when it comes to MCQs, there are 50 MCQs that is going to be tested, and the simulations, 7 simulations are going to be tested in the exam, and the paper is divided into 5 testlets. First 2 testlets are MCQs, and the next 3 testlets are mainly going to be the simulation part. Okay, so this is something is a pattern. So let's start with the first unit. So the first unit is financial statements. So can anybody please let me know how many financial statements are there? How many financial statements are there?
Balance sheet, income statement, comprehensive income, changes in equity.
Okay. And what about cash flow?
Yes.
Yeah, cash flow also. Yes.
Okay. So first we have is a balance sheet, which is also known by the name of statement of financial position. Then we have income statement. So income statement and comprehensive income statement is the same thing. It's not a separate statement. So if the company is having a other comprehensive income, in that case, the company will be preparing the statement of comprehensive income. Otherwise, the company is preparing an income statement only, which is ultimately known as a statement of financial performance. Then we have a statement of changes in equity. And finally, we have a statement of cash flows. So in total, there are 4 statements which company usually prepares. One is the balance sheet, the second is the income statement, the third one is the statement of changes in equity, which also include the statement of retained earnings, and finally we have a statement of cash flows. So first we are starting with the first we will discuss about the balance sheet in this chapter, then statement of income, comprehensive income, statement of changes in equity, and special purpose frameworks. So what is a balance sheet and why the company needs to prepare the balance sheet? Anyone? What content we have in the balance sheet?
Cash position, current assets, fixed assets.
Okay.
Secured liabilities, unsecured liabilities, capital.
Okay. So mainly we have the assets. In one side, we have the asset, which can include the current assets and the non-current assets. Even the investment is also there. In the other side is the liabilities and equity side. So in the liabilities and equity side, we have a current liability, we have a non-current liabilities. Then in the equity side, we have a common stock. We have a additional paid in capital, which is security premium. We have a retained earnings. So usually these are the part of equity side and liability side of the balance sheet. So mainly in the asset side, we have a current asset, we have a non-current asset. In the liabilities and equity side, we have a current liability, we have a non-current liability, we have a common stock, we have a security premium, we have a retained earnings, we have a accumulated other comprehensive income, lot of things. So this is how the balance sheet, these are the items usually we have in the balance sheet. So, one second. Okay. So they are talking about the 4 financial statements first. We have a 4 different statements. The first statement shows the financial position at the end of the period. As of the particular date, we have to prepare the balance sheet. So balance sheet and the financial position is the same thing. Then we have a comprehensive income. So comprehensive income includes the net income as well as the other comprehensive income. So combination of net income and other comprehensive income will make comprehensive income. Then investment by and distribution to the owners. So they are talking about the changes in equity. When I'm talking about the equity, I'm talking about the investment by the owners or distribution to the owners in the form of dividend paid. And finally, we have a cash flow during the period. So cash flow during the period is nothing. It is shown by the cash flow statement of the company. OCI is the other comprehensive income, Sakshi. So we will discuss about the other comprehensive income. We have a complete topic by the name of other comprehensive income, in which usually we keep 4 items. So we'll discuss it afterwards. Yes, Anoop?
Samarth, what is the difference between comprehensive income statement and P&L statement, or both are same?
See, comprehensive income is inclusive of 2 things. Is inclusive of net income and other comprehensive income. Net income is calculated in the income statement, and comprehensive income usually include the net income as well, include the other comprehensive income as well. So when I'm saying statement of comprehensive income, I'm talking about the statement of statement of income as well. I'm talking about the statement of OCI as well. When we combine these 2 statements, it will become a statement of comprehensive income.
Okay, so we can say P&L statement plus other income.
Yes.
So if a company is preparing its trading and profit and loss statements, so whatever is arriving at the as net profit plus the other income part, which is not part of that statement, both comprehend to comprehensive income.
Yes. When we combine the net income and with the net income, I add the other comprehensive income, it will combinedly become the comprehensive income.
Okay, thanks.
Then we are talking about the notes to the financial statements. So on the face of the financial statement, we never show the explanation of any item. Just like on the face of the financial position or the balance sheet, I show the PPE, property, plant, and equipment. And in the property, plant, and equipment, there can be even 10 assets or 20 assets. Property, plant, and equipment. or mainly there is machinery, there is a property, there is a land, lot of assets the company have. So all the assets will not be presented on the face of the balance sheet. What they do, they only show the amount of PPE. And what happened with the calculation of PPE? Calculation of PPE will be done in the notes to the financial statements. So in the notes to the financial statement, it supplement or further explain the information on the face of the financial statements. In the notes, we also have the accounting policies used. Means the method of charging the depreciation is being shown here. The method of inventory valuation is the part of accounting policy. So all these things will be presented in the notes to financial statements. So whatever the accounting policies, accounting principles, accounting methods that is being used by the company, that is something being the part of the notes to financial statements. Then within the notes, if anything is not presented on the face of the financial statement, that is something required as per other disclosures. So other disclosures required by the GAAP. It is also the part of notes to the financial statements. So other disclosures required by the GAAP is the part of notes to the financial statements. Now, whenever we prepare the balance sheet, we usually follow this equation, which is asset is equal to liabilities plus equity. And even when we prepare the balance sheet, we follow this equation. In one side of the balance sheet, we have the assets. In the other side of the balance sheet, we have the liabilities and the equity. So whatever is the total of assets, it will be equivalent to the total of liabilities and equity. So asset is equal to liabilities plus equity. So we combine the liabilities, we combine the equity, and the total is known as an asset, total assets. So on the asset side, we have a current assets, we have a non-current assets. In the liability side, we have a current liabilities, we have a non-current liabilities. In the equity side, we have a common stock. We have, if the company also have a preferred stock, so preferred stock is also there. The company have any additional paid-in capital, which is same as security premium. They can have a retained earnings balance. So combinedly, it will make the equity. So in using this equation, we can calculate other things as well. Like in any case, if we have to calculate the value of equity, we can also say assets minus liability will be equivalent to the equity. So asset minus liability will give you the equity balance. This is also something we can find out using this equation. Is this clear, everyone? Till this point?
Yes, sir.
Okay. So this is how the balance sheet looks like. Normally, when we prepare the balance sheet, we have to show the balance sheet for 2 years. One is for the previous year and for the current year. So ultimately, we are showing a comparison from current year and the previous year. We are showing the comparison, whether we are improving or we are downgrading ourselves. So it is being shown with the help of comparative statement of financial position. So we will start with the current assets. In the current assets, we have the cash balance, we have available for sale debt securities, we have the AR balance, which is same as debtors, we have a note receivable, we have the inventory, same as a stock, we have a prepaid expenses, and we have a total current assets. In the non-current assets, we have any equity method investment, which is the investment for the long term. We'll discuss about it afterwards. What is a equity method investment? Then we have a PPE, property, plant, and equipments. We subtract the accumulated depreciation. We have a goodwill, and total we have is a non-current assets. So when we make the total of current assets and the non-current assets, we get the total assets of $1.8 million. Then we have a current liabilities. We have a AP, which is same as a creditors. We have a interest on the note payable. Then ultimately, whatever the long-term debt we have, long-term debt, or I would say we have issued the bonds for 10 years. Suppose if we have issued the bonds for 10 years, so clearly it is a non-current liability. But if these are the bonds on which the payment will be paid on the yearly basis. So like the value of the bonds is $1 million. And the equal installment will be paid every year. So 100,000 will be paid every year. So whatever 100,000 we have to pay in the coming year in the next 12 months is treated as a current liability. So that is the current maturity of long-term debt is the part of current liabilities. Then we have accrued salaries and wages. It is same as the outstanding salaries, outstanding wages. So the name of some, you can see some accounts name will be different from the Indian accounting names. Like debtors will become account receivable. Stock will become inventories. Fixed assets become PPE. Just like creditors become AP. Outstanding becomes accrued. So whatever the outstanding interest, whatever the outstanding salaries and wages, it will be known by the name of accrued. And usually we use the word payable as well, income tax payable. So these are the total current liabilities. Then we have a non-current liabilities in which we have a bonds payable, which is long-term bonds. Then we have a long-term notes payable, employee-related obligation, any deferred income taxes that is going to be paid or going to be adjusted in the future. Then we have a equity side in which we have a common stock. We have a APIC. APIC is same as additional paid-in capital is same as security premium. We have a accumulated OCI balance. We have a retained earnings, and we have a total equity. When we combine the total liabilities and total equity, we get it is exactly same as equal to total assets.
But what is this employee related obligation and how is it part of non-current liability?
See, employee related obligations is mainly just like in India, what happened, just like provident fund is there. And provident fund is being deducted and it will be deposited with the government. But in US, it will not happen. Like employer will be deducting some part of the whatever the benefit they will be providing in the future. They deduct the part of the salary and they keep it with themselves. And they have some obligation on behalf of those funds towards the employees. So that's why in the future they have to provide the benefit at the time of retirement or at the time of any death of an employee. So that will cover under employee related obligations.
Okay.
Now, what are the current assets? What are the non-current assets? So when I'm saying current assets, so those assets which are converted into cash within the period of 12 months or within one operating cycle are mainly considered as the current assets. Mainly, either you will be able to convert the assets into cash within 12 months or within 1 year or within one operating cycle. That is something is a current asset. So ultimately, it is clearly given cash and other assets or the resources commonly identified as reasonably expected to be realized in cash or sold or consumed during normal operating cycle of the business or within 1 year. We usually call it as a current assets. And what are the non-current assets? So those assets which are usually not a current asset are the non-current assets, because assets will be divided in two parts. One is current, second is non-current. If you are not able to convert your asset into cash within 1 year or within one operating cycle, then it will become a non-current asset. Just like long-term investment and the funds, then PPE, property, plant and equipment. We have intangible assets, we have other non-current assets. So these all are the non-current assets. So investment and funds, PPE, intangible assets or other non-current assets. Just like in the balance sheet also, we have seen current and non-current assets. So cash, securities, which are for the short term, account receivable, not receivable, inventories, these all are the current assets, because that is most probably realized in cash within one operating cycle. And those which are not able to be realized in one operating cycle will become non-current assets.
So this 1 year period is like fixed. Say for example, if the FD is done for a tenure of 1 year, so
Right.
will it be part of current asset? And if
Right,
it is
right.
for 2 year, it
Absolutely.
is, and if
It will
it is
become non-current asset.
non-current asset. So if any FD which is likely to encash in say next 6 months time, though it was for 5 year period, but that will be encashed in next 6 months, so it will part of current asset for current year balance sheet, in current year balance sheet. Am I right?
Yes, you can say that. But we have to check a lot of other things as well.
So do I need to reclassify that?
We have to check whether initially the asset was non-current asset or the current asset. If the asset is mostly the non-current asset initially, so we will keep it as a non-current asset only. We cannot change it on the, like, of only 12 months have been left, so we take it as a current asset. It can be possible for the liabilities, but it cannot be possible for the assets.
Okay. So it will remain in non-current
Yes,
assets.
yes.
Okay.
The next is operating cycle. So what is an operating cycle? Can anybody please let me know what is an operating cycle? And one more question, whether operating cycle is of always less than 12 months or it can be for more than 12 months as well. And if it is for more than 12 months, do we consider the assets as a current asset or we will treat it as a non-current asset?
I'm not exactly sure about the definition, but one thing is sure that operating cycle may be more than 1 year, and in that case, I think current asset can be classified as current asset if the operating cycle is more than 1 year.
Okay. So mainly there are a lot of companies where it will take, like, what is an operating cycle first of all? Operating cycle is it's a cycle in which we purchase the raw material, we convert it into finished goods, we sell it to the customers, and finally we receive the cash. So this is something is the one operating cycle. If most of the time, if the product is very simple product, it is usually produced on a regular basis. So the operating cycle is max to max is going to be for 15 days, 20 days, or 1 month, not more than that. But this operating cycle can extend to 6 months as well, can extend to 12 months as well. And even it can extend to 15 months, 24 months. Suppose I'm dealing in a small machinery. That's fine. I'm just regularly manufacturing the machinery. I'm getting the payment within 1 year time. But sometimes we are manufacturing the machinery which already taking like 8 to 9 months in the production. Then it will be taking like 8 more months to collect the payment from the customer. So in that case, the operating cycle is of 17 months, more than 12 months. If the operating cycle is of more than 12 months, in that case, suppose it will be taking like 17 months to get the payment from the customer, to get the raw material converted into cash. So in this case also, mainly any asset which is going to be converted in the period of 17 months should be treated as a current asset. So if the operating cycle is beyond 12 months, so accordingly, it will be treated as a current asset only. It cannot be treated as a non-current asset. Like suppose sometimes we are dealing in the large machinery and it will like take 2 years to get the inventory converted into cash. For 2 years, we have to keep the inventory with us. So in that case, you can't treat your inventory as a non-current asset. It will always remain as a current asset. But here the period operating cycle can be of 12 months, more than 12 months. Guys, just hold for a second. I'll be back. I'll be back in a second, guys. Just hold. Yes. So if there is any doubt till this point, so guys,
One
you
co
can.
one
Yes,
question
please.
from my side. So let's say, for example, if my current process, whatever it is, maybe service or manufacturing, my company is taking operating cycle of around, let's say, for example, 30 days, 1 month. Now I have some asset which is going to be, matured in next 6 months. So is it fine to show that asset into the current asset, or I have to show it into the non-current asset?
See, if that asset is, suppose, like you have a fixed asset, like you have given a loan to someone, and like that loan is going to be, you are going to recover that loan back from that person in the next 6 months. So still, if it is, so still you are going to receive it in the next 6 months. Still, you can't treat it as a current asset. You have to treat it as a non-current asset only.
Okay,
If
fine.
you have a clear possibility from the very starting that this loan is going to be recovered in the next 12 months, 10 months, 9 months, then you can treat it as a current asset. But if you have no such possibility, like it is continuing from the last 2 years, so it will remain as a non-current asset.
Okay.
Once you receive the money, you'll receive the cash. You can show it as a part of current assets because
So,
cash and cash equivalent is a part of current assets.
right. So that 30 days operating cycle will not impact that.
No.
Okay.
So 30 days operating cycle mainly impact the inventories. Sometimes there are a lot of companies, they have to treat their inventory as their non-current asset. But according to the law, inventory is something that will be used on the regular basis. And it is usually have a operating period of less than 12 months. But even if the operating period is less than more than 12 months, still it is treated as a current asset. It can't be treated as a non-current asset. Like you have a clear idea that whatever the inventory you are purchasing, you'll be keeping it for next 15 months. But still you can't treat it as a current non-current asset. You have to treat it as a current asset because the operating cycle is more than 12 months. So in any case, if the operating cycle is less than 12 months, so practically it is impossible that inventory will be kept for 15 months. So inventory will remain in the company for less than 12 months only. So practically it is impossible that inventory will be kept for more time. But even if the inventory is kept for more time, most probably the inventory will remain the current asset. You can never treat the inventory as a non-current asset unless there is a specific criteria is being applied. There is some exception rule is there that this inventory will remain in the company, and company clearly have an idea that this inventory will be used for, like we have purchased the excess inventory and we are going to use it for the long term. Now the next thing is current liabilities and the non-current liabilities. So when you have a responsibility to settle your obligation in the next 12 months or within within one operating cycle, and these liabilities will be paid off out of current assets of the company, then it will be a current liabilities. So when the obligations whose liquidation is reasonably expected to require the use of existing resources properly classified as current assets. When the obligations are satisfied using the current assets of the company, so most probably it is a current liabilities or the creation of other current liabilities. So I would say we can't say that using the current assets we can only settle the current liabilities. But yes, most probably, like suppose I'm saying any bonds, any long-term bonds are there, and the part of the bonds are going to be settled in the next 12 months. So the part of the bonds that is going to be settled in the next 12 months will become a short-term bonds, will become a short-term liability, and this liability will be settled out of current assets, out of cash, out of some other assets, current assets of the company. So it will be current liabilities. And for the non-current liabilities, those liabilities which are not qualifying as a current liabilities are the non-current liabilities. Like any non-current notes payable, bonds payable, any lease liability, any post-retirement benefit obligation, like you'll be providing any benefit to your employees, you will be talking about the benefit of your employees. So it will be the part of non-current liabilities.
So here the rule is changing. So for example, if a bond is of 5-year period and this year we need to encash that. we need to pay that. So we need to reclassify it from the non-current liability to current liability.
Absolutely.
And but the same rule is not applicable for current assets.
Right. The same rule will
Okay,
not apply for assets, but it will apply for the liabilities.
great. Thanks.
Now we are talking about the next thing, equity side of the balance sheet. So normally the equity is also known as the residual interest in the assets of the company. Residual means remaining interest in the assets of the company. So out of assets, when we pay off the liabilities, whatever is left is the equity interest in the company. So it is a residual after total liabilities are subtracted from the total assets. So we can also say equity is equal to assets minus liabilities. One second, guys. So when it comes to residual means remaining interest after paying off the liabilities from the assets. Whatever is remaining is for the equity. And equity have the four elements. So what are the four elements? First element is a contributed capital. Contributed capital is nothing. Whatever the contributed capital is same as a paid in capital. So this represents the amount invested by the shareholders. Including the par value, including the additional paid in capital. So it is a total of common stock plus preferred stock plus APIC. Contributed capital. What is a retained earnings? So the part of the profits that is being retained by the company, the part of the profits that is not distributed to the owners is somehow considered as the part of retained earnings. The part of the profits that is being retained by the company is something is a retained earnings. The part of the profits that is not distributed to the owners. So like when it comes to retained earnings, so retained earnings by the name itself, the part of the profits retained means not distributed to the owners. So how we start with that? How we calculate the balance of retained earnings? Retained earnings at the beginning, whatever the profits we earn during the year, that will be added here. Whatever the dividend has been declared, it will be deducted from here. We'll discuss about it in the afterwards in a detail. Then any prior period items will be adjusted out of this. And we are left with retained earnings at the end. So I can say that retained earning is nothing. It is a cumulative profit that the company has earned and retained, not distributed as a dividend. So cumulative profits that the company has earned and retained. And not distributed as dividends. So it increased with the net income, it decreased with the losses and the dividends. Retained earnings balance.
Sir, it means it will carry forward next year in balance sheet.
Right. Absolutely. Like you earn a profit of, let me say, $50,000. and out of $50,000, only 10,000 will be declared as a dividend. So what happened? Whatever has been remain, what is being remain in the company, that is 40,000, it will increase the retained earnings balance.
Okay.
Next is the accumulated OCI, accumulated other comprehensive income. So whatever is the other comprehensive income every year, what happened? Whatever is the balance of OCI, that will somehow be added to the accumulated other comprehensive income. So this is the item which is not the part of income statement. So that is why it is not directly the part of retained earnings as well. It will be directly reflected on the face of the balance sheet, in the equity side of the balance sheet, directly on the face, accumulated OCI. And finally, the NCI is there, non-controlling interest. If suppose I would say there is a consolidated financial statements is being prepared, like suppose A Limited acquired B Limited, 80% share of B Limited. So whatever the share they have acquired, that is a controlling interest. And whatever the share they have not acquired, that is remaining 20%, is somehow being reflected as a non-controlling interest. So in case we are preparing a consolidated financial statement, then NCI will come into picture. It applies in case of CFS when consolidated financial statements are prepared when a parent owns less than 100% of a subsidiary. So whatever the share they do not own is somehow considered as a non-controlling interest. It represents the portion of subsidiary equity owned by the outside shareholders. So how much share is not owned by A Limited in B Limited is somehow owned by the other shareholders. So whatever the stake owned by the outside shareholders is the non-controlling interest. So out of 100% share in B Limited, 80% is acquired by A, 20% which is acquired by the other shareholders, outside shareholders, are somehow considered as the part of NCI, non-controlling interest. So we'll discuss about it in more detail when we discuss about the consolidated financial statements.
थर्ड और फोर्थ ना बहुत क्लियर नहीं हुआ अभी, so I think we can discuss it later, maybe in detail.
The NCI you are asking.
NCI as well as this accumulated other comprehensive income.
So once we discuss about the OCI, at that time you'll get a better understanding. So just like the net income will have a balance, in the same way OCI is also having a balance. In the OCI, we usually have the 4 items as per GAAP. And those 4 items, when we combine these 4 items, whatever the balance we are getting, it will be shown in the OCI. Just like net income is the part of retained earnings, in the same way OCI is the part of accumulated OCI balance. Just like we add the 4 items and we have a $20,000 positive balance for the OCI. So what happened? This 20,000 balance will be transferred to accumulated other comprehensive income. If the beginning balance is like 30,000, 20,000 more we are adding. So total balance of accumulated OCI is 50,000.
But what is OCI?
Other comprehensive income includes the 4 items. Just like we have a available unrealized gain and loss from available for sale debt securities, then translation, foreign translation gain or loss. We have a pension adjustments, and we have a whenever there is a loss, when we are presenting the liabilities at its fair value, whatever the loss there will be is something reflected through the OCI. So we'll discuss these 4 items will be there. These will be, we will be discussing in the coming session. So
Okay,
don't worry.
Okay.
There's a complete chapter for OCI, just like
Okay.
you can see we have when we start with the statement of income, after that we have a comprehensive income.
Comprehensive income, yes,
So
sure.
with in the comprehensive income, we'll discuss about it.
Sure, thank you.
So comprehensive income, we can say that it's in short that it is something which is not from their regular operations and something any
you can
income
say
or
it's
loss
the other
generated.
comprehensive income. Yes. Other comprehensive income is like which is not from the regular operations. and which cannot be presented in the income statement. See what happened? Income statement is a temporary account. And whatever the items we are showing in the income statement, like sales, like rent expense, like salaries expense, these all belong to a particular period. These all the items belong to a particular period. And once we have recorded it, it's gone. We are never going to reverse the sales. We are never going to reverse the rent paid, reverse the salaries paid. We are not going to reverse it. But whatever the items we are reflecting in the OCI, just like unrealized gain or loss on AFS debt securities, available for sale debt securities. Today we have like we are going to keep the debt securities for 3 years. In the current year, we have a gain. So we are reflecting the gain in the OCI. In the next year, we have a loss. So that loss will reduce the previous year gain. So this is not going to be a temporary account. OCI balance will keep on adjusting. That's why we are not reflecting it in the income statement, because income statement is something cannot be adjusted again and again. But OCI balance can be adjusted again and again. So that is why we are showing these items separately from the income statement items.
So interest on investment will form part of other comprehensive income?
No. Interest on investment is the part of income statement, but I'm talking about, I'm not showing here. Okay, I'm talking about unrealized
Valuation of our income, like if we purchase some FX and we have that and any loss and gain on that.
It's just for single item, not for all the items. Just a single item.
Just an example of you can say the other comprehensive.
There are three types of debt securities. One is trading debt securities, the second is held to maturity, and the third is AFS. Trading and held to maturity debt securities, whatever the gain loss is there, it is the part of income statement. But whatever the gain or the loss we have on the available for sale debt securities, it is the part of OCI. So there are 4 items which you should know. That's it. Other than that, whatever the items are there for the loss, gain, it will come under income statement.
Okay.
So we'll discuss about it. At that time, I'll explain you.
Right.
Got it, sir.
So why we prepare the income statement? Can anybody please let me know why we prepare the income statement? What's the reason for that?
To understand the net position of the business, what the business has earned, and or maybe what the business has earned in terms of profit, or may have incurred the losses. So to ascertain that, this statement is prepared.
Okay. So how statement of financial position and statement of income is different?
Income statement, I think it's for the particular year, and
Okay.
the balance sheet can be said as YTD level, year to date, or maybe till since the time business has been started.
Okay. Anyone else?
In my view, I think it should be same.
Okay. So when it comes to the balance sheet, as we have discussed, if we have to calculate the value of the company, if we have to calculate the value of the business, we value any business according to their assets, according to their liabilities, equity balance. This is how we calculate the value of the business, value of a company. So if somebody is asking about the value of the company, they have to look at the balance sheet. So balance sheet will give you an idea how what is the position of the company in the market. So if I have to call someone as a rich person, how I can call someone as a rich person? On the basis of their salary or on the basis of the property they hold? So definitely on the basis of property they hold, I can call a person as a rich person. If somebody who is earning like 1 lakh rupees of salary, somebody who's earning 5 lakh rupees of salary, I can't say somebody who's earning 5 lakh is more richer. I can't call them as a rich person. Yes, I can say this person is earning better in comparison to other person, but we can call the person rich on the basis of assets they have. If some company is having more assets, they can be a rich company. Just like there are many Indian companies, we call those companies as a rich company. Why? Because of the assets they hold. Just like Reliance is known as a cash rich company because they have a lot of cash to manage their operations. And whatever the investment they also have, that can be quickly converted into cash, and they are realizing a lot of money out of it. These are the zero debt companies. And why we call them as a rich on the basis of balance sheet? We cannot say on the basis of profits they are earning these companies are a rich company. No. Whatever the profits they are earning, that will be adding something. But you cannot call a company as a rich on the basis of salary, or sorry, on the basis of profits they are earning. So income statement is used differently, balance sheet is used differently. If I have to value a company, I'll use a balance sheet. If I have to check how the company is performing, we have to check the income statement of a company. So revenue minus expenses plus gains minus losses will give us the net income or loss. And whatever the net income or loss we earn, it will be ultimately transferred to retained earnings. It will be transferred to the retained earnings every year. So whatever the income, whatever the loss we are doing, it will be finally transferred to the retained earnings. Just a second, guys. So ultimately, as it is specified, out of revenue, when we subtract the expenses, we add the gains, we subtract the losses, we have the net income or the loss. And whatever the net income, net loss we earn, it will be ultimately transferred to the retained earnings. Close to the retained earning is same as transfer to the retained earnings. So how the income statement looks like? So normally there are three types of income statement will be there. One is single step income statement. The second is multiple step, and the last is condensed income statement. So practically we prepare the condensed income statement. So, but what will be the difference? So in the single step income statement, all the revenue and gains will be combined, all the expenses and losses will be combined, and finally we are having a net income. So by the single step, we have calculated a net income. So that is a single step income statement. So whatever the revenue and gains will be there, that will be combined. So net sales, other revenue, gains, that will be combined. Whatever the expenses and losses will be there, that will lead to the decrease in the profit will be combined. So cost of goods sold, selling expenses, GN expenses, interest expense, losses, income tax expense, everything will be combined, and we have the total expenses and losses. And when we just take out of total revenue and gains, when we subtract the expenses and losses, we have a net income. And when we divide the net income with the number of shares outstanding, we get the earning per common share. So is this clear, everyone? Can we start with the next point?
Yes, please.
Okay. So now we have a multiple step income statement. In the multiple step income statement, here the calculation will be spread into multiple parts. We will start with the revenues. So in the revenues, we have a calculation of net sales where gross sales will be deduct. Out of gross sales, we deduct the sales discount, sales return and allowances, we have a net sales. Then we have a cost of goods sold where the calculation of cost of goods sold have been done. The formula is beginning inventory plus purchases plus direct expenses minus ending inventory will give me the cost of goods sold. So same calculation they have done. Out of beginning inventory, they add the net purchases. So net purchases is calculated as purchase. Then out of purchases, we have adjusted the purchase return and discount. And finally, we have a net purchases. We add the direct expenses, which is transportation in. And when we subtract the ending inventory, we have a good cost of goods sold. So out of net sales, when I deduct the cost of goods sold, it will become the gross profit. Then out of gross profit, when I subtract the operating expenses, they have divided the operating expenses into two parts. One is selling expense, one is the G&A expense. In the selling expenses, we have all the sales related expenses, which is sales salaries, commission, freight out, travel, advertising, office supplies, everything. Then we have a G&A expenses where we have a salaries, professional salaries and wages, depreciation, supplies expense, everything. So we have a total operating expenses. And when we out of gross profit, when we deduct the total operating expenses, we have an income from operations. And in the income from operations, I've added the other revenue and gains and deducted the other expenses and losses, and we get the income before taxes. And out of this, I'll deduct the income tax expense, I'll get the net income. So net income is same as what we are calculating here. It is exactly same, but here we have not calculated just like we are doing in the multiple step. We are calculating using the multiple step, and finally we are reaching to the conclusion, to the answer. But here we are calculating by a single step. So this is not a right way, single step. And even multiple step income statement, you will see that it will be looking it's looking more complicated because all the calculations will be done on the face of the income statement. That is why it is looking difficult. So it is better if we don't have all the calculations on the face of the income statement. So whatever these calculations are, these are usually presented in the notes to accounts, notes to the financial statement. So net sales, out of this, cost of goods sold will be deducted, gross profit will be there. Then gross profit, we have deducted all the operating expenses, selling and G&A expenses are deducted. We get the operating income. We add the other expenses, other gains and incomes, other revenues and the gains, and we deduct the other expenses and losses. After deducting the interest expense, we get the income before taxes. And out of income before taxes, when I deduct the tax expense, I'll get the net income. And that should be divided by 20,000, which is the number of common shares outstanding. I'll get the EPS, earning per common share. Yes, everyone, anything not clear to you? In the exam, they can even ask you to prepare the income statement or the balance sheet. So you have to be sure what type of income statement and the balance sheet they will be asking you to prepare. You are not going to show any calculations, but yes, they will be giving you the format, and in the format you have to just pick the items. Every box will have a drop down. From the box, you have to select the right item, right heading, and then you have to enter the amount. So these type of things can be tested in the exam. Even in the exam, when these type of things will be asked, it looks difficult. But usually it is going to be simple when you have practiced the questions well, you have properly practiced everything, then it will look simple. Otherwise, it will be little difficult. Now, I'm moving to the next thing. Cost of goods sold. Okay. So, cost of goods sold can be calculated from trader's point of view, from the manufacturer's point of view. So from the trader's point of view, they only have a single type of inventory, which is the finished goods. So they'll start with the opening finished goods. They add the purchases. They add the direct expenses, and they subtract the ending finished goods value, and they get the cost of goods sold. In case of manufacturers, they can have a three types of inventory. One is raw material. The second is WIP, work in progress. And the third is finished goods inventory. So ultimately, they have a formula as opening finished goods inventory plus cost of goods manufactured minus ending finished goods inventory. So now you can have a doubt here that how we can calculate the cost of goods sold, cost of goods manufactured. So we'll start with the raw material consumed. So raw material consumed plus direct labor plus manufacturing overheads, it will give you the manufacturing cost. In the manufacturing cost, when you add the beginning WIP inventory and you subtract the ending WIP inventory balance, you'll get the cost of goods manufactured. Okay, so in the cost of goods manufactured, when you add opening finished goods inventory and you subtract the ending finished goods inventory, you get the cost of goods sold. So this is how we can calculate the cost of goods manufactured as well. And now the next thing is, if the question will be asking you to calculate the raw material consumed, the formula is beginning raw material inventory plus purchase minus ending raw material inventory will give you the raw material consumed. So these are the multiple formulas which you should know, because in the examination there is a possibility that they can ask you to calculate the cost of goods manufactured as well. Okay, yes, we can do one or two examples as well, that's fine. But before we start with an example, I just want a confirmation. Can we proceed with the next point?
Yes, please.
Okay. So we can calculate like cost of goods manufactured as beginning WIP inventory plus sum of periodic manufacturing cost. When we subtract the ending WIP, we get the COGM. We can also calculate the cost of goods manufactured like this. It will be like formula with the reversal formula. Like the formula for cost of goods sold is beginning finished goods inventory plus cost of goods manufactured minus ending finished goods inventory. If I have to calculate the cost of goods manufactured using this formula, so in cost of goods sold, when I add the ending finished goods inventory and I subtract the beginning finished goods inventory, I'll get the same thing. Then we can have here the list of expenses. So selling expenses, these are the expenses that are related to the sales. So whatever the expenses related to sales are, it is the part of selling expenses. These are incurred in the selling or marketing. In the case of selling or marketing, whatever the expenses we incur is the selling expenses. Like we are giving a sales representative salaries, we are giving the commission, we are giving the traveling expenses, any sales department salaries, any sales department rent, depreciation, any shipping expenses, any advertising expenses, these all will come under the selling expenses. Next is the journal and administrative expenses. These are incurred for the direction of the entity. Like we are paying a salary to the officers of the company, and they are responsible for giving a direction to the company. So it is incurred for the direction of the entity as a whole and not directly related to a specific function. It's not related to any specific production cost. It's not related to that. It's a journal cost, journal expenses. We have to pay to an accountant. We have to pay to an auditor, to the auditors. We have to pay to the legal staff. This all will cover under the G&A expenses. And finally, the interest expense, it is recognized based on the passage of time. Whatever the interest we are paying on the loan, we are paying on the bonds. So that all covers under the interest expense. The next we have is a continuing operations. So now what is the point of continuing operations? So there are two types of operations are there, continuing and discontinuing. So first I'm discussing about the continuing operations. So when I'm saying continuing operations, like the company is having the two divisions. One is the bat division, the second is the ball division. And the company is planning to close their ball division. They have a clear plans that they have to close their ball division. They are not going to operate their ball division because the ball division is in continuous losses. So in that case, the financial statement, the income statement will be divided into two parts. One is income from the continuing operations. Second is the income from discontinuing operations. So the bad division, whatever the income we generate from the bad division is going to be the income from continuing operations. And whatever the income or loss we do out of ball division, it is the part of discontinuing operations. So they are saying any material items that are unusual in nature, which is not mainly usual. It's unusual in nature. It's not recurring basis. Any infrequent in occurrence or both. These are reported as a separate component of the income from continuing operations. So when I'm saying any material items that are unusual in nature, unusual means it's not happening on the usual basis, on the regular basis. Its frequencies, it is infrequent in occurrence. Occurrence is infrequent or both. These will be reported as a separate component of income from continuing operations. So guys, now before we start discussing about the discontinued operation, I would like to start with some practice questions. So whatever we have discussed till this point, I'll be discussing about the questions related to those topics. Okay. So please stay here. We'll be starting with some questions. With the questions, we'll get more idea. So Endro company has 10 million notes payable that is due in 3 months after the year end. The notes payable was refinanced when the long-term bonds were issued 1 month after the year end for $11 million. So the December 31st balance financial statements were issued 2 months after the year end. So how should Endro classify and disclose the notes? Yes. I want an answer from everyone. It's C, D. What about others? B. Sorry, Muskan.
It's D, sir. D.
D. D. Okay. I want 1 or 2 more answers, please. Yes, Shashank, Gagan, Anoop, Aditya, everyone.
D.
It's D. Okay, then first we are trying option D. Absolutely correct answer. So why it is D, first of all? So it's clearly given the notes payable is due in the 3 months. But these notes was refinanced when the long-term bonds were issued, and these were issued 1 month after the year end for $11 million. So what we are doing, we are saying that this $10 million will be refinanced through the long-term bonds. So ultimately, whenever there is a, just understand the provision here. So what they are saying, whenever any current liability, so this is a current liability. If any current liability is refinanced with a long-term liability, then instead of calling it as a current liability, we call it as a non-current liability. Why? Because the non-current liability will never be removed from the books. As in when we remove this $10 million of the liability, we have to just again show the non-current liability of $11 million. So non-current liability will never be removed. So we have to classify this as a non-current liabilities. And yes, it is required to be disclosed. A note disclosure is required, it's compulsory. So what will be happening here? A current liability is refinance with long-term liability. And whenever this type of case will be there where current liability is being removed and it will be replaced with the long-term liability, then we have to call it as a long-term liability only, non-current liability only. So that is why the non-current liability will be reflected in the books. And yes, the disclosure is compulsory. Great. Here we have a next question. Park Company's professional fees expense account had a balance of 82,000 at December 31st, year 1, before considering the year-end adjustment related to the following. Consultants were hired for a special project at a total fee not to exceed $65,000. Park has recorded 55,000 of this fee based on the billings for the work performed in year 1. Attorney's letter requested by the auditors dated January 28, year 2 indicated that legal fees of 6,000 were billed on January 15, year 2. For the work performed in November, year 1, unbilled fees for December, year 1 were $7,000. So what amount of professional fees expense for the year ended December 31st, year 1 should be? Yes, I want everyone should read it properly and let me know the answer.
I think it's D.
It's D. What about others? Okay, just a simple thing. 82,000 is we have in a balance professional fees expense account. We have $82,000. And now we have multiple adjustments that is required. So consultants were hired for a special project at a total fee not to exceed $65,000. So Park has recorded 55,000. So 10,000 more we have to record. So 82,000 plus 10,000 more we have to record. Then there's an attorney letter which is dated January 28, year 2. So fees of 6,000 that is billed on January 15 is related to November year 1 and 7,000 is related to December year 1. So total is 7,000 plus 6,000. So 105,000 is going to be the total, I think. 1 second. One second, guys. Okay. But why they are not adjusting this? Okay. So I think why this 10,000 is not adjusted, it is because they have not completed the work for extra 10,000. So when this work is being completed, at that time it will be adjusted. So that's why they have not adjusted this 10,000 as of now. So that's why the number answer should be 95,000 only, not 105,000. Yes, Gagan, you are absolutely correct. So why this 10,000 is not adjusted? Because it's clearly given that this 65,000 is the total amount, but 55,000 has been billed for the work performed in year one. So mainly this 10,000 have to be adjusted, what I feel, but they are saying it's related to the work not completed yet. So that's why only 55,000 will be adjusted. And 13,000 more will be adjusted. So 82 plus 13, 95,000 is an answer. But according to me, 105 should be the correct answer. But I don't know why they have not adjusted.
No, I think correct, Samarji. The answer is should be 95,000 only. So, say for example, if I have taken a contract of say 5 lakh rupees, and it's like a periodic contract, and I am completing the work of rupees 1 lakh in year one. So, only the expenses of rupees 1 lakh should be recorded in year one. Otherwise, what
That's
will happen? It
yes,
will
that's
give.
fine. That's fine. But what they are saying, they have clearly specified that Park has recorded 55,000 of this fee based on the billing for the work performed in year
In
one.
year one.
But they have not specified that what happened with this 10,000. Either they will be giving a clear idea that this 10,000 will be completing in year two, year three, whenever it will be
Right.
completed.
That should be given. Right.
Yes. So that's why
Right.
it's according to the question, it should be 105 because we have to assume entire $65,000 of the work should be completed and we have to bill that. Even if we have not billed it, it doesn't mean that it should not be the part of revenue. It should be the part of revenue. Sorry, expense. So, but they have not given it. So I think something is missing. But according to what they have given in the answer, 95,000 is an answer. But they have to specify. Usually, when in the exam you will be getting the question, they will be clearly specifying everything that this excess 10,000 will be something considered as an expense for the next year when actually we get the professional services, when we are actually giving the professional services.
Right. Right.
They should
Right.
be specifying that.
Right.
Okay, so we can do this question again. Next question now. So included in the Lee Corporation liability account balances at December 31st, year 4 were the following. 14% of the note payable issued on October 1, year 4, maturing September 30, year 5. That is of $125,000. 16% notes payable issued on April 1, year 2, payable in 6 equal annual installments of 50,000 beginning on April 1, year 3, that is of 200,000. Lease December 31st, year 4 financial statement were issued on March 31st, year 5. Then on January 15, year 5, the entire 200,000 of the balance of 16% note was refinanced by the issuance of a long-term obligation that is payable in a lump sum. In addition, on March 10, year 5, Lee consummated a non-cancelable agreement with the lender to refinance the 14% 125,000 note on a long-term basis on a readily determinable terms that have not been implemented. Both the parties are financially capable of honoring the agreement. There have been no violation of the agreement provisions. So on the December 31st, year 4 balance sheet, the amount of notes payable that Lee should classify as a short-term obligation is. It's a good question, I would say. So if you read it properly, most probably you can easily answer it. So what should be our answer?
I think B.
B, 125,000.
Beta.
Anyone else? Guys, whatever you are thinking, just let me know. It doesn't require that every time you have to be correct, but yes,
Yeah, I
whatever
think
is your
it's B.
it's B. Okay,
Yeah.
great. More answers, please. I think everyone is with B. Yes. What about Gagan, Anoop, Sakshi?
Clarity नहीं आ रही है समर्थ इस पे ना, sorry.
Okay. Okay. So few students are saying option B. So we can try first option B. But this is not a right answer, guys. Both the loan,
I think it's C because they refinance the 14%
both the
also.
loans have been refinanced with the long-term debt. So nothing should be a short-term obligation. No short-term obligation will be there on the company. So $0 is going to be the short-term obligation. So 0 is an answer. Yes. Option C is going to be the right answer. Perfect. I think everyone is clear. Because it is clearly given, I don't know why you have not read it properly. It's clearly given that entire 200,000 balance of 16% note was refinanced by long-term obligation. So it itself become a long-term liability. Then they are giving one more point that on March 10, year 5, there is a non-cancelable agreement with the lender to refinance 14% 125,000 note on a long-term readily basis. It's already refinanced with the long-term note. If it is already refinanced with the long-term note, it has already become a long-term liability. So ultimately, 0 is going to be the short-term obligation. $0 will be an answer. Option C is the right answer.
Actually,
Okay, it was
I was confused on these terms like
They
that
have
have
not yet
not yet
not im-
implemented. That's
Yeah.
why, yes.
Okay.
good question.
So now I'll be taking a quick 5-minute break, and after the break, we will discuss few more questions, 2-3 more questions, and then we'll start with the next topic, discontinued operations. Okay. So we can
Thank
take
you.
a quick break.
Thank you.
Thank you. Let's start everyone now. Okay.
Yes.
So here we have this question. The trial balance of Trey company at December 31st, year 6 has been adjusted except for the income tax expense. We have a cash, AR, prepaid taxes, AP, common stock, APIC, retained earnings, foreign currency translation adjustment, revenue expenses we have. Then it's clearly given during year 6, estimated tax payment of 300,000 were charged to the prepaid taxes. Trey has not yet recorded income tax expense. There were no differences between the financial statement and income tax income, and the Trey's tax rate is 30%. Included in the AR is 500,000 due from a customer. Special terms granted to this customer require the payment in equal semi-annual installment of 125,000 every year, every April 1 and October 1. So how much amount should be reported in the total retained earnings? Please read this question carefully and
Sir, what are the other three options?
Sir, question please थोड़ा नीचे.
anyone?
Sir, can you show the option one more time?
Yes.
Option D.
Option D. Great. I want one or two more answers. Option D. Great. What about others? Anyone else?
Option D, till the time this 5 lakh account receivable has some adjustment.
Okay. Absolutely correct. Absolutely correct. How we will do it? So we have 630,000 in the retained earnings. We already have. We have revenue and expenses, which is going to be how much? Which is going to be $1 million. And $1 million after tax is going to be adjusted here. So we have not made any adjustment for prepaid taxes and any adjustment for this 500,000. Why? Because it will not be affecting our total retained earnings balance. In any case, it will not be affecting us. If they will be asking us to calculate the correct balance of assets, they will be asking us to calculate the correct balance of AR, then it is required to be adjusted. But in this question, we are not required to make any arrangement of these two additional informations. And in the retained earnings, we already have 630 in the retained earnings. We'll add 1 million, which is the net income before tax. We'll make an adjustment of 30% taxes, and 700,000 needs to be adjusted, which will give us 1,330,000 as an answer. Absolutely correct. Great. This question is
But
looking difficult, but
yes,
ultimately, if we have to do an adjustment of these points, then it will become difficult. But here we don't have, we are not required to make any adjustment of prepaid taxes because it will not have any effect over the retained earnings. Again, AR balance is 500,000. It will not have any effect over the retained earnings.
Sir, what about this FCTA, foreign currency translation adjustments?
This is the part of OCI. So this is something
OCI.
I'll explain you
Fine.
afterwards.
Fine. Okay.
Okay. Guys, let's do this question and then we will start with the next point. On December 31, year 4, Largo Incorporation had 750,000 notes payable outstanding due on July 31, year 5. Largo borrowed the money to finance the construction of a new plant. Largo planned to refinance by issuing the non-current bonds. Because Largo temporarily had excess cash, it prepaid 250,000 of the note on January 12, year 5. In February, year 5, Largo completed a 1.5 million bond offering. Largo will use the bond offering proceeds to repay the note payable at its maturity and to pay the construction cost during year 6. What amount of the note payable should Largo include in the current liability section of its December 31st year 4 balance sheet?
It's C 750.
750. Anyone else?
I think B.
B. D. Okay. I'm getting 3 different options, B, C, and D.
D, I think.
Okay, so let's try option D first. It's not a correct answer. I don't know why option D is why everyone is saying option D is an answer. You will only show $0 in your answer.
As a current liability.
As a current liability. But 0 is not the correct answer. So they have a note, which is 750,000 and due on July 31st, year 5. Means in the next 7 months, it is going to be due. It is going to be paid. So Largo borrowed the money to finance the construction of a new plant. So Largo planned to refinance the note by issuing the non-current bond. So they will be planning to refinance it by issuing non-current bonds. That's fine. Because Largo temporarily had excess cash, it prepaid 250,000 of the note on January 12, year 5. In February, year 5, Largo completed $1.5 million of the bond offering. So let's try. Option B is the correct answer. Why? See, out of 750,000, they are planning to refinance it, but they also have a excess cash. And how much excess cash they have? 250,000. So 250,000 will be paid by the company in cash, and remaining is going to be refinanced with the long-term note. So whatever they are going to pay in the cash, that is on January 12, year 5, it will be reflected as a current liability. So that's why 250,000 will be reflected as a current liability. B option is the correct answer. Still, if you have a doubt, just let me know so that we can discuss it. Yes, guys? Is this clear or is there?
Got it, sir. Clear.
So
Great.
what is this 1.5 million bond offering? So it is nothing.
It's a new bonds, I would say. It's a non-current
It
liability
has
that will be
no
reflected.
relation to this.
No. It's only 500,000 we are refinancing. Whatever the previous bonds are there, first of all, out of 1.5 million, 500,000 will be repaid to the old notes, and 1 million is the new bonds, I can say.
Hmm.
Mm. Okay, this one is the good question. We can do it. In Dart company's year 2 financial statements, year 2 single step income statement as prepared by Dart's controller, the section titled revenues consisted of the following: sales, purchase discount, collection of AR, written off, account written off that were not expected to be recovered, that is 10,000. So total revenues we are showing is 263,000. So in its year 2 single step income statement, what amount should Dart report as a total revenue? So they will be asking you to make a correction of an error. That's it.
C, option C, I think.
Option C. Anyone else?
Yes, option C.
Absolutely correct. This is a good question. If guys you want to try it, you can try it. It's a good question, I would say. The company pays the commission to its sales staff at the 3% of the net sales. Sales staff are not paid the salaries, but given the monthly advances of $15,000. Advances are charged to the commission expense, and reconciliation against the commissions are prepared quarterly. Net sales for the year ended March 31st, year 1 were $15 million. The unadjusted balance in the commission expense account on March 31st was 400,000. March advances were paid on April 3, year 1. So how much the company should report in their income statement year ended March 31st, year 1 as a commission expense?
Option A.
Option A.
Option A.
Option A.
Perfect. 3% of the net sales will be reflected as a commission expense. That's it. Perfect answer. It's an easier question. 18. Okay. Guys, let's do this question and then we will start with the next point. Kelly Incorporation had $4 million of the note payable due on March 15, year 2, on January 28, year 2, before the issuance of its year 1 financial statement. Kelly issued long-term notes, long-term bonds in the amount of 4.5 million. Proceeds from the bonds were used to repay the note when it came due. How should Kelly classify the note in its December 31st, year 1 financial statements?
D.
D.
D, last one with separate
Okay.
disclosure.
Why not C? I think it's C. C.
C. So first of all, there's a $4 million of the note payable is there that is due on March 15, year 2. On January 28, year 2, before the issuance of its year 1 financial statement, Kelly issued the long-term bonds in the amount of 4.5 million. And these proceeds were used to repay the note when it came due. How should Kelly classify the notes in its December 31st? So few students are saying option B, option C, some are saying option D as well, and we have an answer option A as well. I want few or more answers, 1 or 2 more answers, please. Option C. So let's try option C first. It's not a correct answer, guys. They are not clearly saying that these notes are refinanced with the long-term bonds, but ultimately this $4.5 million of the bonds we have issued, and these bonds are going to be refinanced with the whatever the notes we have is going to be refinanced with the long-term notes we have issued. So that's the reason. So that's why we cannot classify it as a current liability. We'll definitely classify as a non-current liability, and we will make a separate disclosure as well. When this type of case will be there, the disclosure is compulsorily required. Clear now, everyone?
Yes.
Great. Now I'm coming to the discontinued operations. So what is a discontinued operation? Like, just like I'm taking an example of bat and ball department. Like ball department is continuously making the losses. So the company have decided to close down this department. So if today we are deciding, it doesn't mean that our operations will be closed from today only. No. If today we have decided, today we are stopping the production. We are saying, okay, let's complete the production for today. And from the next day, we will not do any production. But definitely from the next day, you will not do any production, but you have an inventory in your warehouse. You have to sell that inventory. You have the assets which you have to sell. So ball division, even if we are planning to close it out, but still we have to sell our assets, we have to sell our inventories, whatever we have. So ultimately, it is something going to be disclosed. So this ball division is shown as a separate component of an entity that has been disposed of or classified as held for sale. So this ball division will be classified, whatever the assets we have in this ball division, it will be classified as held for sale. And it represents the major line of business or geographical area. So discontinued operation include any major line of business, like we are closing down one of the division of the company, we are closing down any geographical location. So that is something covered under discontinued operations. So I'm writing here, it's a component of an entity that has been disposed of or classified as held for sale. Means what I'm saying, as soon as I'll get a perfect customer for purchasing my asset, I'll sell my assets.
Sir, here held for sale is specific for the asset, not for inventory, right?
Right.
Okay.
So inventories are normally always held for sale. Only the fixed asset is something we classify it as held for sale, because inventory, suppose you have a stock in your company, in your warehouse, that is always meant for sale.
Right.
But some specific assets like machinery we have, some building we have, some equipments we have, so that is something we have to keep it as held for sale. Now when it comes to the presentation on the income statement, so discontinued operation is reported below the income from continuing operation after the results of continuing operation have been disclosed, and whatever the items we have in the discontinued operation, it will be reported separately net of tax. So it is reported separately net of tax after the results of continuing operation. But what should be included in the discontinued operation? I'll be adding one point here. What should be included in discontinued operations? So the first is operating results. Net of tax. What is the operating results? Like, suppose you have some inventory in your warehouse. You have to sell that inventory. So whatever the inventory you have in your warehouse, you have to sell that inventory and it will be classified as held for sale. So you have to sell your inventory. So it will be classified as the part of operations. Even if the department is discontinued, but still it is the part of operations. And whatever the loss, whatever the gain you will be doing out of operations, that will be reported separately. So it includes the components income or loss for the entity reporting period. Next is any gain or losses on disposal of assets. Second, loss from write down to fair value. minus cost to sell. Means what we do, whatever the assets we have to reduce the value of the assets towards its face value. And one more thing, whatever the assets are held for sale, it will not be depreciated. On the day we have decided that we will discontinue our operations, from that day we will never going to depreciate our assets, because depreciation will be charged when the assets are in use. If the assets are not in use, you cannot charge the depreciation. So that's why after you have decided that you will discontinue your operations, you will not apply any depreciation on an asset. And every time you have to just re-measure your asset at lower of cost. So what we do here, we are applying lower of carrying amount or fair value minus cost to sell. So if carrying amount is lesser, we will show at carrying amount. If fair value minus cost to sell is lesser, I'll show at that amount. And whatever the gain or the loss will be there, that will be reported in the discontinued operation section of the income statement.
And how this fair value will be determined?
So in the exam, it will be given to you. So don't worry. Mainly the companies calculate, and for companies, fair value is same as a market value. So whatever is the market value of the asset, that will be its fair value.
Fair value.
Now I'll be taking one or two questions regarding the discontinued operations. So I'll be taking the first question. Let's say at December 31st, year 1, B company classified one of its business components as held for sale. So the component qualifies as a discontinued operations. So during year 1, the component had operating loss of $120,000. At the year end, the carrying value was 800,000, but its fair value minus cost to sell is 730. So if tax rate is 30%, how much loss should we report in discontinued operations in year 1? Yes. So I want an answer from everyone.
$1,20,000, and separately the lower of this 7,30,000 should be reported as separately.
So what should be our answer, guys? Everyone? So first of all, there is a loss. Zero. So loss from operations,
120.
120,000, and we have to do it net of tax into 1 minus tax, which is 30%.
Mm.
So it's going to be 84,000. Then loss on write down of inventory,
70K.
loss on write down of asset or component, that is 70K.
70K.
How? 800,000 is the carrying value and fair value minus cost to sell is 730.
730.
So it's going to be 70,000 into 1 minus 0.3,
49.
49,000. So how much?
133.
133,000 is going to be an answer. Is this clear now, everyone?
Yes, sir.
Okay. So now I'm just coming to the next point, comprehensive income. One second. So in the comprehensive income, mainly all the changes in the equity of a business during a period, except those from investment by or distribution to the owners, will be coming because of net income and other comprehensive income. So comprehensive income include two components. One is the net income and the other one is the other comprehensive income. So when I'm saying other comprehensive income, it includes the four components. So those items that are not included in the net income calculation will cover under the other comprehensive income. So it includes all the items of comprehensive income that is not included in the net income. So the first item is unrealized gain or loss on available for sale debt securities. So debt securities will be classified into three parts. One is trading debt securities. The second is trading debt securities are those which are kept for the short term. When we start with the fourth unit, at that time we'll discuss about this AFS debt securities in detail, what are the journal entries and everything. But trading debt securities are those which are kept for the short term. As soon as we make the profit, we just sell it and make the profit. That's it. Next is the held to maturity. Normally, when you invest in the bonds have a maturity period. And you have a clear intention to keep it till maturity. And when you have an intention to keep it at maturity, so that will come under HTM, held to maturity securities. We have nothing to do with the other comprehensive income with these two type of debt securities. The third is AFS debt security, available for sale. I will not have an intention to keep it for the short term. I will neither have an intention to keep it for the long term. So that is something is AFS securities, available for sale. I'm ready to sell it, but as soon as I'll get the profit, I'll sell it. The next we have is a foreign currency translation gain or loss. For foreign operations. Anyone have an idea what is a foreign currency translation gain or loss? Anyone?
When we convert our financial statement into the reporting currency,
Okay.
any changes deriving from that?
Any changes deriving from that? Okay, I think that's absolutely correct answer. So there are two types of foreign currency. Transaction gain and loss is different. Translation gain and loss is different. Transaction gain and loss is the part of income statement. Like we are purchasing the goods. Suppose today we decide to purchase the goods. Today the dollar rate is $80 rupees per dollar. And in the future, when we have to make the payment, at that time the dollar rate is 82. So when we make the payment, the dollar rate is higher. So ultimately there is a loss to us and it will be recorded in the income statement. But here we are not talking about a transaction. Here we are talking about a translation. Translating the financial statement from one currency into another currency. That will be something known as a foreign currency translation gain or the loss. Just like I think everybody knows about the company named as Infosys. So Infosys have their subsidiary in US. And their subsidiary name is Infosys Incorporation. So whenever the Infosys is preparing the consolidated financial statements, they have to report all the assets, all the liabilities, all the revenue, expenses, everything of Infosys Incorporation in the rupee terms. So they will be translating the dollar balance sheet into Indian currency balance sheet. And because of this translation, there is a possibility that you will have some gain. Why there is a gain? Let me take one example. So suppose on 1st January 2024, Infosys is showing, suppose Infosys Incorporation have an asset of, let me say, $200,000. In 2024, the dollar rate is 82. So at that time, they will be reflecting their assets at 164. So I would say 1 crore 64 lakhs. But now what happens? On 1st January 2025, this dollar rate has been increased. And the same assets, which is of $200,000, will now be reflected at 85. So the value of the asset in the Indian rupees have been increased and it will become 1.7 crores. And because of this, the gain have to be recorded in the books. And what is the amount of gain? $600,000 of the gain should be reflected because the value of the assets will be increasing. How you can adjust this increase in the value of an asset? Actually, in the dollar terms, there is no increase, but the increase is coming because of translating them into rupee terms. When we are translating the dollar asset into rupee terms, ultimately the gain will be there. And the gain will be of 600,000 will be there, 6 lakh rupees will be there. And this gain will be reflected as foreign currency translation gain. And this gain or loss keep on adjusted on the regular basis. This is not a one-time gain, one-time loss. When we prepare the balance sheet like on 31st March, or we prepare the balance sheet in the next year on 1st January 2026, there is a possibility that dollar rate is 90 or the dollar rate is 80. There is any possibility is there. So that's why we will show it under foreign currency translation gain or the loss, because it is not an actual gain, actual loss. When we are reflecting the dollar assets in the rupee terms, because of that, the gain or loss will be a rise and that will be reflected, and that is a foreign currency translation gain or the loss, and that will be reflected in the OCI. Is this clear?
Yes.
Great.
Yeah.
The next is the changes in the fair value of financial liabilities that is attributable instrument specific credit risk. So every financial liability have its own risk. Every financial liability have its own risk. That is a credit risk. Whether we will get the money, whether we are able to pay the money back or not, there is a financial risk, or there is a risk in terms of change in the interest rates. So because of that, what happened? The financial liabilities value can increase or decrease. Just like we have issued the bonds, and there is a likely chances that value of the bonds will increase in the market. And when the value of the bonds increase in the market, it means we have to pay more amount to clear our liability. When these type of changes will be coming in the bonds, and the value of the bonds are increasing and decreasing because of the credit risk. So what will happen? Whatever the increase or decrease in the value of the bonds will be there. Like if the financial liability will be increasing, it is a loss. When the financial liability is decreasing, it's a gain. So it should be reflected as a part of other comprehensive income. And the last point is gain and losses derivatives qualifying as a cash flow hedges. Means the company do a lot of get their whatever the investment, their investments, they get those investment hedge through the derivatives. So whenever the company have entered into the derivative instruments, there is a most likely chances that derivatives can be reflected at a gain, can be reflected at a loss. So if there is a gain or loss on the derivatives instrument, that will be qualifying as a cash flow hedges, like we are hedging our position. So if this type of case will be there and there is a gain or loss on the derivative instrument will be there, it will be reflected under OCI. Because derivative is not treated as an investment, but on the regular basis, there can be an increase or decrease in the value of the derivatives will be there. So that should not be reflected in any way. That should be reflected by the way of other comprehensive income. So these are the 4 points that will be reflected under other comprehensive income. This is as per US GAAP, and as per IFRS, there are total 5 points. And the 5th point is revaluation gains. So if there is a revaluation surplus, revaluation gain, that is something only being the part of IFRS. And this is not being treated in our exam. So because as per US GAAP, the revaluation of an asset is not allowed. So that's why revaluation gain or revaluation surplus is not the part of US GAAP.
Sir, in this third point, why not financial asset is being covered?
Financial assets, whatever the gain and loss on the financial assets will be there, it is something is a part of income statement, not the part of
Okay.
OCI.
Okay.
Okay. So now this is very important. Mainly from examination point of view, this is not important at all because nobody will be asking you about what 4 items will be there, which is the part of OCI. They'll be giving you just like you should have an idea about these items. That's it. Where it comes, it is the part of OCI or it is the part of income statement. You just have this idea, that's more than enough. Nobody will be asking you to make a calculation for this. So everything will be clearly specified, like we have a loss on foreign currency translation gain, we have a loss on foreign currency translation, we have a gain on foreign currency translation, we have a gain on the derivatives, we have a unrealized gain on AFS debt securities. Everything will be given. You should only know about the presentation, where it will be presented. That's it. Nobody will be asking you about the calculation of anything like this. It will never be the part of our exam. Okay. Only you should know about where the items will come and what are these 4 items. That's it. You should have an idea about that. That's it. So now I'm just coming to the reporting. How the other comprehensive income will be reflected. So an entity that presents a full set of financial statement that has no items of OCI need not report the OCI or the comprehensive income. Suppose if any company is there, they do not have an item of OCI. So they are not going to reflect, it's not required for them to reflect comprehensive income statement. They're only going to present the income statement, that's it. No need to show the statement of comprehensive income. But if it has the items of OCI, they have the two options. One is they prepare one continuous statement in which first they calculate the net income, then they calculate the comprehensive income. And the second option they have is prepare the two separate but consecutive statement. First they prepare the statement of income, then they prepare the statement of comprehensive income. And how it looks like, we'll be discussing about it. See, when they prepare the single statement, what they do, they start with the revenue and gains. First, they calculate the net income. And within the net income, they add the OCI net of tax. And when they add the OCI net of tax, which is 110 plus 25, they get the comprehensive income of $135. Then, in the same way, they can also prepare the two separate statements. Like first, they prepare the statement of income, which starts from here and end here. Then they prepare another statement of comprehensive income, which starts from net income and will end at comprehensive income. So it's depend on the company whether they have to prepare one single continuous statement or they will be preparing two consecutive. They are preparing one single statement or they will be preparing two separate but consecutive statements. It is dependent on the company. So once you are done, guys, just let me
This
know.
third line, gain on sale of available for sale debt security. So this available for sale will be part of income or this OCI?
Just, I think this is one of the confusing point. In the OCI, if you just recognize, in the OCI, we record the unrealized holding gains or losses. Holding gains or losses means we have not sold it yet. We are holding it. Means,
Okay.
one second. So we have an unrealized holding gain. Unrealized means we already have a debt instrument. We have not sold it yet. We already have it. So when we actually make a sale of it, it becomes the part of income statement. Till the time we are holding it, whatever the gain or loss unrealized is, that is the part of income. That is the part of OCI. So if you can see here, we have written unrealized. And what is written in this third point is gain on sale. It's a realized gain, not an unrealized gain. When the gain is realized, it becomes the part of income statement. Till the time the gain is unrealized, it is the part of OCI. Clear now?
Yes. One more point. This is like only presentation, or we are posting the entries in the books of accounts for this OCI. So say for example,
No journal entry will be recorded.
So it is presentation only.
Journal entry will be recorded, but not for every transaction. Just like we record the journal entry for unrealized holding gain and loss on AFS debt securities. What will be the journal entry? We have to increase the value of AFS debt securities. So AFS debt securities will be debit and other comprehensive income will be credit. If there is an unrealized gain. If there is an unrealized loss, just an opposite entry will be recorded. OCI account will be debit and AFS debt securities account will be credited because we have to decrease the amount.
Okay, okay. So entry shall be posted.
Yes. Journal entry is going to be very important from examination point of view. I would say for most of the questions, if you are getting the SIMS, for most of the SIMS, they will be asking you to record the journal entry for most of the SIMS. If you have given any of the paper in India, you have never seen that journal entries being tested. Even in the CA exams, in the ICAA exams, they never test the journal entries. But CPA exam, you will be finding out a lot of journal entries. If you have any confusion in the journal entries, it will become very difficult to pass this paper. So journal entries is very important, especially for the SIMS. Yes, Sakshi, what's your doubt? Can you please let me know what's your doubt here? See, you have two options. One is you prepare a single statement, which is a statement of comprehensive income. You prepare a single statement where you first calculate the net income, just like we have done in the income statement. Then within the net income, you will be calculating, after net income, you will be calculating OCI net of tax. And once you add the OCI net of tax, like OCI net of tax is 25. Once you add this in $110, you'll get the comprehensive income. That is $135. Okay. The second option we have is we'll be preparing two separate statements. One is a statement of income, which is same as income statement. Then whatever the net income I get, the second statement I'll be preparing is a statement of comprehensive income. And this statement of comprehensive income will start with the net income. Whatever the net income I've calculated here. Then I'll make an addition of OCI net of tax. And whatever the final balance we have is the comprehensive income. So guys, now I'm not moving to the next topic. Statement of changes in equity, we will start in the next class. We are not starting now. Okay. So in the next class, I'll be completing all these topics with the special purpose framework, and we will start with the next unit as well. Okay.
Fine, sir.
But make sure everyone is practicing the questions, because when you are practicing the questions, you will be getting an idea that how this concepts will be applied practically. Because just like we have solved many questions, I just feel that it's very, very important that we should solve a lot of questions, because if we solve a lot of questions, there's a most likely chances that in the exam we will be able to perform very well in the MCQ part. And in the exam, from the examination point of view, I can clearly say, if you are able to solve each and every question from the GLIM or whatever I think everyone have the GLIM. So if you solve each and every question from the GLIM MCQ question, most probably the similar MCQ you will be getting in the exam. So out of 50 MCQ, I can easily say that 45 or 46 MCQs will be like whatever you have solved in this GLIM portal. And Others, you have to put the efforts, but you can easily solve it. So in the MCQ part, I can say you can easily score 50 out of 50. And for simulations, we'll practice in the class. I'll just help you how to deal with the sims, how to handle the exhibits. That will be the part of the sims. So that we will discuss within the class itself, and you will get an idea most probably. So it's easier to pass this paper. I can easily say that. And the syllabus is also not very difficult. After the evaluation scheme, after the changes have been there, FAR has become quite easy now. Okay. So thank you so much, everyone. Thank you for your time. Bye-bye. Thank you.
Thank
Thank you,
you,
sir.
thank you, thank you,
Thank you,
sir.
everyone. Bye.